Hi, good evening, everyone. Welcome back to the channel. So in this video, we're going to discuss the topic of investing and whether or not it's really risky. And this is going to be a review of the markets in 2024 and historically as well. I hear a lot of people say that they would rather stick to conservative investments. They don't want to be risky because they feel like, the market could drop and this and that. The market does absolutely drop. And we're going to go over that. But we're also going to show that more often than not, the market is up. And in a 10-year time frame, typically 7 or 8 out of those 10 years, the market tends to be up. Let me announce the Discord that I'm live, and then we will proceed. Okay. All right. So we're going to start out with looking at some charts here. We're going to go over the historical performance of the S&P, the Nasdaq, and the Russell. Those are the three that I consider to be the three biggest and most important market indexes. The Dow is not representative of the overall market. Okay, so we are going to look at the S&P over the last basically 100 years since 1926, and it looks like we have an ad here. Let me close this one out. The desktop's a little slow here. My apologies. Okay, close. Okay, so what we're looking at here, this is just slick charts. This is from 1926. This is right before the Great Depression started. Now, the Great Depression, I will say, dissuaded a lot of people from investing. Almost a whole generation was scarred by the Great Depression. But if we look at 1926, 27, 28, for the S&P alone, had some really good years. This was 11.62% in 1926. 37.49 in 1927, and then 43.61 in 1928. So in those 3 years, it did phenomenally. But then in the 4 years ensuing, we were down 4 years in a row. And in the last 100 years, that's really the only time in the last 100 years that we've had 4 years in a row that we're down. Let me try to find a different site because this site has a lot of ads on it. Um, let's use this one here. Okay, this is what I was looking at yesterday, macro trends. This one's probably going to be a little bit better. Okay. So macro trends is going to be here. Oh, look who we have on, Pay the Piper. Welcome. Yeah, I'm just going over historic market returns here. Maybe we can do a Discord live stream later. Okay, oops, wrong window. Let's go over here instead. Okay, come on. Macro trends. Let's see here. Where did it go? Oh, I guess it literally is the same slick charts. My apologies. Oh, 5 minutes, then you'll catch the live show then, and that's it. Okay, let's just stick to this then. Okay, so the point I'm trying to make here. So we had 4 years during the Great Depression, which really scarred people. We were down 8.42% in 1929. And this year, it's only showing 8.42% despite the crash of 29, because that happened in October. So that was the last quarter of the year. And then we had 25% down. Then we had a whopping 43.34% down. Then we had a fourth year that we were down, but I believe things started to recover by this year because it was only 8%. And then by 1933, happy days are here again. We were 53.99% up. The next year, we were slightly down, but flat basically. And then we had the next 3 out of 4 years were up. And then we were down in 1937, 35%, up again 1938. And then we were down 3 years in a row after that. So this period of time from 1926 to 1941 scarred probably a whole generation of people. But after that, from the 40s on, 42, 43, 44, the World War II years, we were up significantly each year, peaking at 1945. Then we declined again. And then look at this. After this, we had 6 of the next 7 years, we were up. We were only slightly down in 1953. 54 was a great year. That's a 53% return almost, just one shy of the number of the year. 31% the next year, 6% the following year. Then we were down. Then we had 4 years up, 1 year down, and then 3 years up, 1 year down, 2 years up, 1 year down, and then 3 years up, and then in the '70s, we had 2 years down here. But this period after 1941, okay, we went for, like, 30 years of more ups than downs after that Great Depression period. So we got our stuff figured out. By 1974, we were down 26% when we had 2 years up there. Then in the next, like, 10-year period, look at this, we had 3 barely down years. When we got into the '80s, things really roared. '81, we were slightly down, '82, '83, '84, '85. So in these years, look at this, from the '80s all the way to, like, '99, this was an incredible, this was almost a 20-year run. In a 20-year period, we only had 2 down years, and then after that, we had 3 years in a row we were down, year 2000, 2001, 2002. So things change as time moves on. Obviously, Y2K was a big deal. I think the markets didn't know how to exactly react to that. Then we had 9/11 the next year, turn of the millennium. We have big things happen throughout history that tend to jolt the market one way or another. And then after this, we went for the next one, two, three, four, five. We went for the next 5 years up, and then 2008, we were way down 37%. That's almost as much as we were down in the year 1931. That's our second biggest decline in the recorded history, 37%. But then since then, look at this, from 2009 onward, we've had one of the most incredible performances of the S&P. 26% in 2009, 15% in 2010, and then 2% in 2011, 16% in 2012. How about this one, 2013? I remember this year, 32% up, 13% the following year, 15 it was 1.38, 11.96, and then 21.83% 2017. 2018 we were slightly down, but then look at this, 31% in 2019, 2020, 2021. And this is one of the funds that I use in my 401k, the S&P 500 fund. So we've had, out of the last 6 years, 5 out of the last 6 years, we've had not only double digit returns, but an almost 20% rate of return. And these last 2 years have been phenomenal, almost identical, 26% here, almost 27% here. Of course, we were down in 2022. That was the only year, only one of 2 years in the last, really 15 years that we've been down in the S&P. So all in all, as you can see, it's up more often than it's down. So now what I want to look at is cumulative return, S&P 500. And these returns typically are way higher than what you're going to get in CDs and money markets. Okay, so here's some brief. This is just AI generated, but cumulative returns of the S&P. So this year we're at 26%. The long-term average, it's saying 10%, but if you compound it, it's way higher. And if you include for dividends, there was a stat out there that shows that reinvested dividends include for like account for like 75% of the S&P's returns. But this is saying this annual total return includes dividends, and it's is the investment return received each year. The 10-year total return over the last 10 years is 313.7%. In only 5 years, 116.2%. The 20-year total return of the S&P 500, and 20 years accounts for 2008, by the way, which was one of the worst years ever in terms of the market, 856.7%. How about that? Let me share that screen with you all. Then we're going to look at the NASDAQ and the Russell. See, this is what I just went over, 26%. It's averaging 10%, and this is just AI generated, 314% here, 116% for 5 years, 857% over 20 years. And then the NASDAQ, we're going to look at the NASDAQ next. This is over 45 years because the NASDAQ is newer. So we're going to share this one next. So is investing risky? Yeah, you're gonna have some down years, but the bulk of the years are gonna be up before we switch from the S&P. Okay, here's a stat I want to go over. For the 94 years ended on December 31st, 2019, the S&P 500 posted positive calendar year returns 73% of the time and negative calendar return years 27% of the time. So 73%, those are odds that I would go with for sure. Compound annual rate of return. So over the last 10 years, it's been 15%. From 1970 to 2023, 11%. 2011 to 2020, 13.6%. The last 5 years, including for 2022, 15%. That's incredible, folks. Okay, now we're going to turn our focus to the Nasdaq. Okay, so Nasdaq. Okay, from 1971 to now, obviously the cumulative return has been incredible. So by year, this is what I want to focus on. Um, in the 50, how many years is this? 52 years? Let's see. That would be 72, 73, 74, 75. Okay, counting 1972, so that's 1982, 92, 2000, 2012, 2023, or 2022. So that's 52 years. Okay, so in the 52 years of the Nasdaq's existence, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So 14 out of the 54 years have been down. What does that mean? That means 40 out of the 54 years have been up. That's a 74% rate of up versus down. The best year of the Nasdaq was the year 1999, the tech boom. So in the 70s, we had 17% here, down 31, down 35, up 29. You see, it rebounds very quickly and it stays up for a while. So the ups versus downs, like I'm saying, your up years are far more than your down years. So, like I say, NASDAQ is one of the big funds I'm in the 401k. And I'm even thinking about just doing like TQQQ on moving my main 401k to an external account. Okay, so 88, 89, 90. So the 90s were absolutely on fire. We only had 2 down years. 91, 56%, 15, 14, down 3, up 40 here. Look at this, especially the second half of the 90s, 95, 96, 97, 98, 99. You'll probably never see that again, what we saw in the 90s there with the tech boom. 40%, 23%, 22%, 40% again in 98, and then 85.6% in 1999. And then the next 3 years we were down. So that's what you call market correction. So the market does self-correct. But moral of the story, when you have new innovation, new technology, in this case the internet, which started really phasing in to being adopted by the average household in the late 90s, um, you see those returns like that. And that was insane. If you put everything in the NASDAQ at that time, I'd be fine having everything in the NASDAQ, period, not just in this time. But then, of course, you have years like this where 3 years in a row we were down. We were down 40% here because when you have a return like this, you're going to have a correction. That's unsustainable. So 40%, 21%, and then 31%. The good thing is when you're in an index like this is why I advocate for index investing, because when you're in an index like this, you are protected from individual security risk. So in the tech boom, a lot of individual securities went bankrupt. But when you're in the NASDAQ, this is indexed for, you got basically all of these funds in there. And then by 2003, we were back up to 50%. 04, 05, '06, '07, and then of course we had the crash of '08. '09, we were right back 44%, 10, 11, we were slightly down. Now 2011, I remember, was skewed by a lot of political infighting over the deficit and budgets and stuff like that. So they shut the government down a couple of times, which affected the markets. Otherwise, we probably would have had a positive year that year. And then 2012, 2013 was phenomenal between the S&P and the Nasdaq. It was a great year for investing. Now, these tend to be years after an election and after a new term starts for the president and the Senate and the House. So you see, 2009 was one of those years, 2013, and then again in 2017. And then 2021 wasn't as good, but you can go back like every 4 years and see '05 wasn't so good. Of course, '01 was one of those years, but we were in the middle of a recession basically that actually started under the previous administration. But you see, '97 was one of these years. And then 93 was one of those years too. So the rule typically applies, like you see in '09, 13, there's 14, 15, 16, 17. 18 was slightly down. 19, 20 during COVID. These tech stocks did phenomenally during COVID. 2021, 22, we were way down, but you have to be able to stomach these. So you see, since 2009, in the last 15 years, we've only had 3 down years in the NASDAQ in the last 15 years. So actually, the odds are increasing even more. So that's 12 out of 15. That's 80% instead of 74%. So the historical average of up years for the NASDAQ is 74%. That means in any given year, there's a 74% chance that the NASDAQ is going to return a positive return in that year. But if you factor just 2009 onward, it's actually 80%. So the numbers have gone up if you extrapolate just that time period. So is investing risky? Really not all that much. Um, Let's look at cumulative returns of the Nasdaq here. I want to do the same thing I just did for the S&P. Nasdaq is one of our best indexes, I feel like, of all time. Um, let's see here. And you can actually work for the Nasdaq too. Let's see here. Since inception, this is what I want to share here. We might just skip the Russell because I focus mainly on Nasdaq and S&P. So if we skip the Russell, let's go over here. The Nasdaq 100. This is just the top 100, but the Nasdaq 100 since inception is up 1,260%. 10 years, 420%. 5 years, 178%. 1 year, 55%. And this is what I'm in my 401ks. My main one, which I'm way up in, it's a lot of Nasdaq. In fact, I'd say the large cap Nasdaq fund is like half of it. So then we got the biotech and then the composite. That you have the different components of it here. So these are phenomenal returns, folks, since inception. But you see the last 10 years, actually, it's doing better over the last 10 years than it has since inception if you extrapolate out every year. Now let's look real quick at the Russell. So Russell is the small caps. The conventional wisdom typically is that the small caps are like the up and comers. So typically the conventional wisdom is that these are going to outpace the others. Now imagine everything we've talked about with options trading and stuff like that on these indexes when they've done as well as they have. Okay, now I want to look performance by year. Let's see if I can find it. Huh, harder to find. Maybe this is it. Okay, here we go. I want to get this by year if I can. The maximum. It's not going to show it to me. Oh well, we got the gist of it with the Nasdaq and the S&P. Let me see if I can go here and Russell 2000. It doesn't come up. Oh well. Well, You know, it's gonna be similar for that one. I'm not sure why we're not finding any data for that one. Maybe we can try one more time on Slick Charts here. It doesn't have it for the Russell. I guess because it's not as popular of an index. But anyway, I can say this. I can just do it myself on the phone here. So the Russell, since inception, my phone goes all the way back to 1987. Since 1987, the Russell 2000 has returned 1,800%. So that's actually outpacing the NASDAQ. Over the last 10 years, it's returning 87%. So not all that great. Over the last 5 years, it's 34%. Year to date, it is 11%. If we go over the past year, it's 9%. So there we go. That's what we are looking at. All right, folks. Hope that was enlightening. Thank you all for tuning in. Like, comment, and subscribe, and join Discord. And we will see you all in the next one. Take care. Bye.